This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
Back in October of last year, I had the pleasure of discussing the generational opportunity in energy stocks with Leigh Goehring. At the time, he made a very compelling investment case for the energy sector, and in just the 5 months since then, it's nearly doubled in value. Leigh and his firm still believe energy offers compelling value, but to truly appreciate it, it helps to also understand the related bubble in both renewables and electric vehicles. In this conversation, Leigh's partner, Adam Rozencwajg, shares his views on the mania in these so-called green energy stocks, outlining why renewables and EVs are not the panacea for climate change investors believe them to be, and why, ironically, the best way to profit from the transition to green energy may be in the very stocks ESG investors are shunning today. So without further ado, please enjoy my conversation with Adam Rozencwajg.
You ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Adam, welcome to the show.
Thank you so much for having me. Happy to be here.
Yeah, it was great to talk to Leigh a few months ago, your partner, about the opportunity in energy. And obviously that, the timing worked out terrifically. Energy's, performed fantastically well since that time. But I thought it would be fun to, chat with you about kind of the flip side of that. But before we get into that, I'd love to learn a little bit more about you and how did you first become interested in finance in the markets?
Sure thing. So I've been working on Wall Street since college. Right out of university, I went to go work in investment banking at Lehman Brothers for a while. But actually, before that, when I was still in university, I had a summer internship at Neuberger Berman, and I worked for a portfolio manager there named Sandy Pomeroy, and had just a wonderful experience. She very much became a mentor of mine. And after I'd sort of finished burning myself out in investment banking, as one is apt to do for a couple of years, I called up Sandy and I said, do you know anyone who might be hiring on the buy side, anyone sort of looking at security analysis and things of that nature? And she said, well, you really might want to call my husband, who at that time, Leigh, was managing the Chilton Global Natural Resources Fund. And so I did that in 2007, and I've been working for Leigh and with Leigh ever since.
It's funny how, it just things work out fortuitously in that way that, you can find somebody to work with who's not only a brilliant, investor, but also, a good, seems like from the outside looking in, at least, a good partner. So absolutely.
It's been a really enriching and just a wonderful experience. So absolutely. I lucked out.
So that's really how you came to the commodities and energy space. Was you were introduced to Leigh? There wasn't really anything in your background that said, "Hey, I really want to focus on commodities."
No, that's exactly it. What I was looking for, and what I thought was really interesting about the commodity markets, was there's just a huge amount of data that you could analyze, and a huge amount of research that you could try to do and undertake, as opposed to things that relied a little bit more on consumer behaviors or what have you, that were sort of prone to more sort of abstract things. It seemed like you could really kind of dig in deep in the commodity space, and you had a lot of sort of supply and demand numbers to work with. And if you had a interest and an understanding of trying to figure out some of the trends in that data, there was probably a lot to tell you. And I think that's really sort of been the experience that I've had ever since.
Well, it certainly seems like, especially in recent years, it's become an area within the markets that, have drawn little attention. It's one area where it seems like there's opportunity to do a fair amount of research and digging and find opportunities, simply because so many of these stocks and sectors and things have been left for dead. So,
absolutely. And, I think, if you're ever debating the efficient market hypothesis, all you have to do is look at the commodity markets, because here you have things like copper and oil that have gone from up 150, 200%, and then lose 80% of their value, and then come right back over the period of only year or two in some cases. And so clearly, not all of those prices were efficient in the sense that they weren't all incorporating all the information there. And so there's definitely a huge advantage if you're willing to dig deep and if you're willing to take a little bit of a contrarian viewpoint. And I think nowhere is that more prevalent today than in the energy markets and on, as far as things that are undervalued and as far as things that are overvalued, that's probably nothing is more true than on some of these renewable energy names where the underlying fundamentals there are just really challenged in some cases, and yet investors are just pouring capital into that space. And I think that's probably the most interesting part of the markets today.
Yeah, and that's really what I wanted to discuss with you is, I spent a fair amount of time when I had Leigh on the podcast talking about that opportunity in energy. And really, I think energy, whether you're talking about traditional energy versus green energy, it to me is almost a perfect representation of what my friend Diego Parilla has called anti-bubbles. And, energy feels like the anti-bubble to the bubble in green energy. And you can't really, I think, fully appreciate, the anti-bubble without understanding the bubble itself too. So, first of all, let's just get, why do you, I guess, what tells you right now that green energy renewables are in a bubble?
Well, I think there's really two different things that you can look at, and they both suggest that really things are moving a little bit, almost parabolically at this point, which is usually a sign of investor euphoria and things like that. The first is how much money is going into the space, and you can look at things like, the shares outstanding of the various ETFs, which are just absolutely exploding. You can look at things like the price of a lot of these stocks and securities, and we're now in a corrective phase in some of them, and actually looking a little dramatic now. But as of a few weeks ago, some of the hydrogen names, for instance, were up almost 3,000% from their sort of early 2000 levels. Now that's been cut back almost in half in some cases. So I think you might be starting to see finally a little bit of recognition that perhaps too much capital was put into that space. But if you just look at some of the moves, I'm talking about things like Plug Power, things like Ballard, Tesla, obviously, was a market darling last year. I would sort of group that in the whole renewable energy transition bucket, and that's really been sort of the flip side, I think, to the energy trade last year. And if you look at money coming out of that space and then going into some of these new energy transitions, that's really one sign that we look at. The other sign is a little bit more fundamentally driven and frankly is a little bit scarier in some ways. And that is if you look at the underlying project economics that some of these renewable deals are now getting done at, and particularly in wind and solar, we're talking about, we've heard indications of onshore wind deals being negotiated with a 4% project IRR. So that is to say, if you're an onshore wind developer and you go to bid a new wind farm and agree to power tariffs and that sort of thing, in certain parts of the world, you're forced to sort of take a 4% project IRR, and that is then levered up 75% debt to equity to make it an acceptable, equity level IRR. But that's really scary for a whole variety of reasons. One being some of the assumptions on how long that wind turbine is really have to be productive in order to sort of get your feasibility study 4% project IRRs. If instead of 25-year lives, if that only lasts 24, 23 years, all of a sudden that project is eaten through its equity cushion pretty quickly. So there's some pretty scary things that suggest that a lot of capital is going into the market from the fundamental, on the ground project by project level. And then certainly if you look at the price of the stocks, they're all suggesting just a huge amount of capital being poured into that space.
Yeah, and I love that you mentioned Plug Power because that's one that came and just smacked me in the face, recently. That I remember, when I was, back at our hedge fund, my partner started buying Plug Power. We had a value mandate. And so when he started buying Plug Power in 2000, I thought, oh my, what the heck we just can't do this. It's completely against our mandate. But I mean, Plug back then went from, like $30-$40 a share in 98 to, split adjusted $1,500 a share, and then all the way, back to $5-6 is, and now it's up to 43 again. The performance has been amazing, but it's still down, like 95% plus from those highs in 2000. So but I think the other thing that I would point out there too is that the market cap is not really down from 2000, that they've issued so many shares, to probably fund losses over the years. That, to me, that was one that just was so reminiscent of the dot-com mania. But, you mentioned also EVs too. I don't know if you saw Research Affiliates put out a piece today on EVs where they basically show that the entire global auto market doubled in valuation and market cap last year, mostly driven obviously by EVs, even though the potential for autos in the future obviously hasn't doubled. And that to them is the definition of a mania, is when you have the parts worth greater than the whole. That's obviously mathematically impossible for all those companies to play out. So, EVs also, you mentioned valuations, Tesla, the price to sales ratio on these things just is mind boggling.
No, absolutely. And I think it really is an example of, the sort of strange logic on Wall Street where, Tesla sporting a greater market cap than the entire rest of the auto industry sort of goes less questioned than some of these energy companies that, effectively, some of them, maybe not anymore, but certainly going back 6 or 7 months ago, if some of these companies never drilled another well again and effectively went into full liquidation mode, they would probably have been doubles. But people were scrutinizing that hugely as opposed to some of these names, like Tesla or like Plug, which, like you said, has seen lofty values before and then, destroyed a huge amount of value in the past. And whether or not it does it again remains to be seen. But certainly it feels as though we're in a mania in some of these technologies. And what's really frightening to us in some ways is just some of the physical challenges. That's all on the price side of things. That's all on the investor sentiment side of things. But if you then turn and look at some of the challenges that these technologies face technically, that's where I think there's a real strong disconnect between the price action and then the challenges that these guys face in the real world.
Yeah, and I want to get to that because you guys make some terrific points about this transfer going from a relatively efficient, sources of energy to dramatically more inefficient sources and the problems with that. But before we tackle that, I want to just get your thoughts about some of the vehicles and I think strategies that are behind this. The green bubble. It's hard to really separate the green energy bubble from ESG and the popularity of SPACs. It's amazing how much money has been raised by SPACs in over the past year, and especially so far this year. A lot of that money's going into these blank check companies. That money's going into renewables, EVs. Do you think the unique features of SPACs versus the traditional IPO process have helped to inflate the bubble in green energy?
I think so. I think that, the SPAC phenomenon, which you've obviously done a lot more work on than I have, but, from my sort of position, and we don't do anything in the SPAC space really other than watch from the outside with skepticism. Obviously, it's a very unique structure, but I think it's reflective of basically free cost of capital that we've had for the last however many years, that now, we have a vehicle that's effectively a private equity fund of one that's going to make one acquisition, has sort of an embedded put option in it, and is able to attract, billions and billions of dollars sight unseen. And so to me, that's just really a function of zero cost of capital. And that's going to have all sorts of market distortions. And if you combine a fundraising vehicle like that with a theme that is very attractive to people, which clearly the energy transition is, I think that's probably a recipe for a mania, which is what we're seeing today. And I understand people's attraction to the energy transition theme. When you look forward and when people talk about carbon emissions, it sort of does seem clear that a change will have to take place. It seems as though, I think this is the huge error that people are making. There's a perception that all this takes is a little bit of, deep thinking and technological wizardry that the answers are just out on the horizon. And I think that's the mistake that people are making. But if you sort of back solve and you say, well, we're going to have to replace the entire global infrastructure, there seems to be a huge amount of capital needed to do that. And so you can make the case that maybe some of these guys with the silver bullet will be able to have a pretty good next couple of decades. But I think it really puts the cart before the horse in the sense that a lot of these technologies, like I said before, really don't make a lot of sense. So while the narrative is attractive, I think when you dig a little bit deeper, there's some problems there. And when you have a narrative that's attractive and capital that's easily accessed, a lot goes out the window. And I think that's what you're seeing today.
Yeah, and I think you hit the nail on the head there in terms of the narrative. I mean, it seems to me, SPACs are allowed to promote and create projections, in ways that a traditional IPO process doesn't allow for. So you see companies that literally don't even have a working, prototype, of an EV or whatever, and they're projecting, billions of dollars of sales and promoting the heck out of the stock in ways that you can't do typically, through an IPO process. But, to me, that promotional ability and these unbelievably aggressive projections are firing up this mania to a degree. But it's also ESG. I really love to know your thoughts on ESG, because so much money has been flowing into ESG, and it's been accelerating over the past couple of years. How much do you think the popularity of ESG has helped inflate the bubble in green energy, and conversely, depress this anti-bubble in traditional energy?
I think it's been huge. If you look at traditional energy, it peaked out at about 30% of the S&P. Granted, that was all the way back in 1980. And in this last cycle, it got down to 1.8%. So I think, that doesn't happen regularly. That doesn't happen. There's obviously a normal ebb and flow of all industries that sometimes they're overvalued and become large part of the S&P. But I don't think there's, and maybe you can correct me if you know this, but we've not been able to find a sector that's gone from being a third of the S&P to less than 2% of the S&P. And in order to get that, I think you really need forced sellers. And so I think, ESG has played certainly into the massive undervaluation and what I would say the sort of once in a generation opportunity in more traditional energy like oil and gas and E&P and things of that nature. So that certainly happened. Now, as far as ESG pushing capital into green areas, I think that's really happened as well. And there's a variety of reasons for that, and there's a variety of reasons for why people are globbing onto the ESG bandwagon. And I think part of the issue has been that for the last 5 or 6 years, if your ESG guidelines told you to stay away from the extractive industry, so oil and gas and metals and mining, with the exception of the last 6 months, that was probably the right decision. And so you've been able to have this sort of strange, have your cake and eat it too moment where you can do right by the environment, do right by society, and enjoy a tailwind on returns. In general, it's not clear that should persist going forward in the sense that ESG limitations, it's difficult to argue how limiting your investable universe will add to returns. You would think that over time, having fewer options, almost by definition, can only hurt returns. So we'll have to wait and see, particularly when you get a bull market going in some of these things that have been now starved for capital, like metals and mining and oil and gas, how that'll have to be adjusted. But I think that absolutely the sort of narrative around ESG investing has certainly pulled a lot of capital into the green energy sectors. And the problem really, there's a host of problems, and people have debated whether or not it's effectively the investor's role to become involved with environmental concerns, or whether that's better left to other parties. But really what I think is kind of interesting is that, and a little bit discouraging, is that even if you think that it's the role of the equity investor to set governance policies to help promote good environmental outcomes. What the ESG frameworks are pushing people to do is not going to result in that. We're not going to get the reductions in CO2 that people hope for. And we can talk about why that is, and we can talk about the countries that have taken on huge renewable mandates and really haven't seen the impact in CO2 emissions that one might expect. And we can talk about all that. I think it's fascinating. But turning it around a little bit, we manage a strategy, a natural resource equity strategy. We do own oil and gas in there. We do not own renewables for a lot of the reasons that we can talk about. But we have about 20% of our portfolio in uranium, and uranium has been shown time and again to be the only source of base load carbon-free electricity. We also own about 15%, I believe, of the fund in copper-related equities. Now, copper is clearly critical to a lot of developmental plans in terms of electrifications of places like China and India. But if we do get a renewable push and a huge wind and solar push, copper, we're going to need a lot of copper to be able to do that. So, right there, we sort of have, 35% of the fund in things that we think, and frankly, we know are key pillars to a carbon reduction strategy. And yet, according to any ESG metric, we don't rank all that high. Now, I should point out that the benchmark S&P weighting of uranium is pretty much zero. So to have a 20% uranium weighting is drastically overweighted technology that's been shown to help reduce carbon, and yet the ESG metrics don't pick it up. And so that's where you kind of end up, kind of shrugging your shoulders and saying, well, I don't really know what we're trying to accomplish with a lot of these frameworks, and do they really sort of make sense to sort of formalize, because they end up missing a lot of what we're trying to actually accomplish.
It's such a great point, and I think that's my biggest problem with ESG is the framework, the metrics they use. Because Tesla is a popular ESG stock, probably overweight in every ESG fund you might look at, and you've done a terrific amount of research on just the carbon production that goes into the batteries and these things that are created. But to me, it was when Tesla decided to invest their cash into Bitcoin, which is obviously a major, carbon source of carbon being put into the atmosphere. How do you keep Tesla in an ESG framework, after that? And on the flip side, you have a stock like Occidental Petroleum, who's investing heavily in carbon recapture. And, that stock's excluded from ESG. So I think that the framework itself is very flawed, and you make a really good point. But I want to get to, the capital that's flowed in, because to me, one of the things that made energy so attractive was kind of these companies started getting starved for capital after the oil price crash. And the oil price crash was really created by all of this, cheap capital that the companies were able to raise after the financial crisis. Fed takes interest rates down to zero, and there's cheap money to borrow and go drill. And then we get the oil price crash in 2014. It seems to me that all this capital that's now flowing into green energy is going to inevitably create a similar type of bust in that sector. Do you think that's reasonable?
I do. I think it's almost more than reasonable. I think it's almost becoming a foregone conclusion. And like I said, you just have to see some of these projects being bid on now with 4% project IRRs. And I can tell you that in the worst of the capital glut in the E&P sector. And you could debate whether or not they were sort of cherry picking their best areas and wells and whatever. But the E&P companies still at least pretended to have a 10% plus project IRR, and including most of them said that their wells could do 30 and 40%. Now they might have been stretching there a little bit, but I was just astounded to see sort of where these companies are agreeing to sort of bid new projects at. It's a really, really thin margin. It's a function of how much capital is at work. It's obviously a straight line between seeing the capital go to work, seeing more people compete for the same projects, and then seeing the expected IRRs come down on those projects. But you're talking about, for what's a very, very, very physical process still, you're talking about an extremely thin margin as far as I'm concerned. And then obviously you sort of add on to that any project in my mind, or not any, but a lot of projects that then sort of have to go on and rely upon structured financing and debt in order to sort of make the equity capital work. That's when you're sort of in those later innings of a capital cycle. And I think that's what we're seeing in the renewable sector too. So I think that it's, just to put these numbers in perspective, modern day wind farms are being modeled with assumed 25-year lives on the windmills. The early generation windmills and wind turbines, a lot of them have suffered sort of early degradation and have lasted 15 years or so, where they were expected to have lasted 20. Now, if you talk to the industry, they'll tell you that they've learned a lot from those first generation windmills and turbines. And now you're talking about, having been able to take it from 20 to 25 years expected lives and be able to hit those numbers a lot more reliably. But we won't know. And so to me, and sort of as a value investor who likes to think about a margin of safety, when you don't know something, you better have some sort of a margin there to be able to protect you and a buffer. And instead, we have a very, very thin buffer, like I said, single digit IRRs at the project level, made attractive by adding debt. And, that just very rarely ends well.
Yeah, it's, to me, it's fascinating. I mean, you could almost just devise, an investment thesis, a longer term investment thesis just around capital flows. When you see tons of capital flowing into a sector, you could be assured the returns are going to go way down. And I think that's, what we're seeing. But, a lot of people have also made the point recently that, these bubbles, while they end up being bad for investors, can end up being good things for society. So, you think about, probably the best example I can think of is the internet bubble. And there was so much capital flowing into the networking sector. And, we laid so many fiber optic cables and stuff through cheap capital, during that time that, when the dot-com mania bust, NASDAQ went down 80% plus, and investors, Cisco, famously still below its 2000 peak. But it laid the foundation, for the internet and all the, what we're recording this podcast on now. And so do you see that happening here again, maybe with renewables, and that, investors may, get hammered again, but there could be good things that come out of it for society?
That's an interesting question, and that's the most hopeful and optimistic take I've heard, on excess capital spilling in. But I suppose the question I guess you'd have to ask about the internet is, what would have developed if we had not laid down all that, at the time, unproductive capital? Would we have sort of been able to move to a more efficient allocation? And the answer is I really don't know. The problem that I see with the energy transition and the green energy bubble that's taking place right now kind of cuts the other way, which is to say there's some interesting technologies out there. They're not necessarily getting the same attention, or they definitely are not getting the same attention that wind and solar and lithium-ion batteries are, but they are very promising in terms of helping to alleviate global CO2. And what I'm thinking about things like some of the technology surrounding some of what they call the small modular nuclear reactors, which sort of help with safety concerns and things like that, and might actually help provide a tailwind towards us rolling out widespread nuclear power. Things like new technologies of creating steel that potentially could limit the amount of carbon that's emitted. These are really hard engineering tasks to accomplish, but there's people out there that are trying to do it. And I think on some of the best technology, what we see anyway, and a lot of these are sort of earlier stage and private and what have you, but some of the more off the run technologies that are out there, I actually see some promising developments. And what I worry about most is that if you have a big bubble in green energy and energy transition and stuff like that, and all the air comes out of it, what does that do to the capital availability for those technologies that actually could work? Does that just set the entire sort of theme back a decade or two? And that would be a real shame. Because I do think that there's some good things that are out there, and we saw something a little bit similar to that about a decade ago, or a little bit more, where quite a bit of money was drawn into the battery sector at the time, and batteries, I think, are just the most fascinating and interesting topic I can ever imagine, because they're so poorly understood by the layperson. There's sort of a prevailing view that battery technologies we're just around the corner from a major breakthrough. And I think what a lot of people don't realize is that the modern lithium-ion battery was developed in the early 90s and has basically been improved upon incrementally ever since. But about a decade ago, there's a lot of money that got pulled into that sector, sort of a mini bubble in battery technology, and a lot of impaired capital, and basically sort of a lost decade almost of battery development after that. And so, I think that that's the biggest risk. If you have serious capital, which now you do, the battery bubble, I don't know that anyone even really noticed it, other than there was some embarrassment for the Obama administration when some of these companies that had government funding went bankrupt. But now it's a different story. Now you're talking about trillions of dollars, I think, going into a lot of these more conventional renewables. And if there's problems there, I mean, I think that really risks setting back some of the more interesting future technologies. I think your view is definitely optimistic, but I think unfortunately is probably not likely. The other challenge with some of the renewable technologies like wind and solar, notably, is that there's sort of this view that once we get the windmills up and once we get the solar panels up, they'll just create clean and efficient and abundant energy forever. And obviously, it's true that the wind is a renewable resource. We're not going to run out of wind. We're not going to run out of sunshine. But people do forget that the infrastructure, the windmills and the solar panels themselves, have very finite lives to them. I mean, it's sort of amazing, but in many cases, the life of a windmill or a solar panel is probably less than the life of a oil and gas well. Whereas the oil and gas well is definitely perceived to be, every molecule you produce, you're never getting back, and we're just perpetually running out. I guess that's true, but at the same time, the life of a renewable wind and solar asset are definitely finite as well. And so, if you, unlike fiber optics and unlike network infrastructure, which basically has a usable life, probably, I don't know, I'm not a telecom analyst. My brother-in-law actually is. I should ask him, but I presume that these fiber optic networks probably have a useful life of 50 plus years. Whereas on the renewable side of things, you're talking about having to replace those assets fairly quickly.
Yeah, I'm glad that you bring up not just the problems with the transition, but potential solutions. I mean, that's one of the things I really liked about reading your latest piece. But I want to dig into a lot of before we dig into the solutions. I want to help people understand the challenges with a lot of these optimistic scenarios. You in your latest report, you write, we estimate the move toward renewables and EVs would generate nearly 45 billion tons of incremental CO2. At best, a huge amount of the expected carbon savings will be undone by the necessary manufacturing. At worst, the impact could be net detrimental. Can you just help kind of explain some of the numbers behind that conclusion?
Yeah, absolutely. So I think a key concept, and it might sound a little bit, academic and intimidating, but I think it's pretty intuitive once you really think through it. A key concept here is the idea of energy return on energy invested. So other people call it, life cycle analysis and things like that. So it's looking at a system, an energy system, and taking account of all of the usable energy it produces in relation to the amount of energy that's required to make the system work, if you will. So in the case of a coal-fired electricity generating facility, you're talking about all of the energy needed to develop the coal mine, manufacture, or rather mine and produce a ton of coal, process the coal, get it to the power plant, and then burn it, because obviously the power plant itself has a certain efficiency factor, and so you lose some of the energy there. And so you look at over the life of the entire plant, what is the total energy in relative to the total energy out, and that's known as the energy return on energy invested. And it's an incredibly fascinating topic, and unfortunately, it's one of those topics. The more you read, you kind of go down a rabbit hole a little bit. But by and large, traditional hydrocarbons, whether it be modern day efficient natural gas plants or coal plants, are basically operating in the order of magnitude of 30 to 1. So you generate 30 units of power for every unit of energy that comes in. If you think about it another way, it's the reciprocal of that, which is 1 over 30, about 3%. That's how much energy gets consumed by the system itself. And the rest is available for use to end users. When you make the transition to wind and solar, you're talking about energy systems that are fundamentally, almost an order of magnitude less efficient. And where does that come from? It really comes from, I would say, sort of 3 different areas. The first place that it comes from is that inherently wind and sunlight are less energy dense than burning a lump of coal. I think we all understand that intuitively, that, when you think about all the heat and energy that comes out of your barbecue in the backyard or whatever, gas powered grill, and you consider, even the force of a stiff breeze, you're wildly different in terms of the energy density per unit of area and things of that nature. So the first thing that people have to realize is that in order to get that amount of energy out of sources like wind and sun, you're talking about big things, and big things require a lot of energy to build. So right off the bat, your energy return on energy invested is not in the same order of magnitude. Put a different way, traditional hydrocarbons have basically captured millions of years of the Earth's temperature and pressure in order to embed all that energy into the coal or natural gas itself. And then you as the end user are taking advantage of that. And you don't get that when it comes to wind and solar. So right off the bat, if you just looked straight up at the wind turbine, or if you looked at the solar panel, you're talking about, instead of a energy return on energy invested of 30 to 1, you're talking about, at best 10 to 1 on a gross basis. Now, what do I mean by that? Well, gross basis means that it does not take into account the number one problem with wind and solar, which is that they're intermittent. They don't always generate power. And obviously the people in Texas have seen that recently. But that's a problem of every windmill and solar panel around the world. There's effectively 2 or 3 different sources of intermittency. There's day to night fluctuations. There's clouds passing overhead, or changes to the breeze minute to minute. And then there's seasonal variations, winter to summer weather patterns. And each of them need to be addressed in a different way. So one of the suggested ways that people have proposed to mitigate sort of minute to minute issues is to overbuild the amount of wind and solar that you need, and to build it out, over a big geographic area. But to put that in perspective, if you have a 1 megawatt solar facility, it at best will generate 20% of that potential dispatch. You compare that to coal plants and natural gas plants that can operate with much lower downtime. You're talking about 75, depending on maintenance schedules and things like that. But I think 65 to 75% efficiencies or uptime is not uncommon. So right off the bat, you have to overbuild to get the same amount of useful power coming out the other side. And in many cases, the feasibility studies suggest overbuilding to an order of magnitude of 2 to 3 times what you actually might need, if not more, and then effectively just dumping that excess power when it gets created, if at all possible, because that's sort of the cheapest way to get around some of this intermittency issue. The other thing, obviously, overbuilding is not going to get you through the night and things like that. So the other thing that you really need in order to talk about realistic wind and solar, you need a lot of battery backup or some type of energy storage. Now, there's some areas that you can do this. You can do pumped hydro, where you basically pump water up a hill and then let it go down a hydro plant in order to generate power. That works if you have water in a hill. But if you don't, then that's obviously not going to be feasible. And most people, if you're talking to them seriously about sort of widespread renewable power agree that they feel that it has to be lithium-ion battery storage. Now, there you're back to the same problem as Tesla. It takes so much energy and so much carbon to create these batteries to back up the solar and wind. And particularly if you're talking about trying to do all this to then run a Tesla, so now you have an energy undense medium such as wind and solar. You need to back it up at the site using batteries. You need to overbuild it, you transmit it. Then you have a battery on the other end to drive a car around. It ends up with a process that's dramatically less efficient. Now, the question there is the efficiency loss enough to offset the additional or the additional CO2 that burning oil and gas comes with? And that's where things get really kind of interesting, because as we wrote in the letter, at best, a lot of that gain will be undone. And at worst, depending on how polluting the current grid is to create the wind and solar infrastructure, it could actually be a net negative. So you look at a country like Germany, who's had a huge renewables push in the last 20 years, and they've seen their carbon per unit of energy go down by about 13%, which is largely in line with what the U.S. has done, even though we've had no renewable mandate to the same extent that they have. So that's where I think that these problems really arise. The first is just a question of energy density, and the second is the overbuilding and the batteries that are needed. And what you're left with is an energy return on energy invested. Instead of being 30 to 1, you're talking about something that's anywhere between 1 to 1 and 4 to 1. Or put another way, something where either 25 to 75% of the total energy in the system is consumed getting there. So I'm sorry, I went on for a long time there. I'm sure all of your listeners are now fast asleep.
No.
But I'll take a stop here.
That's perfect. It's actually fascinating stuff, and I'm glad you brought up the real world example of Germany, because the gains that they've made have been a lot less than what was anticipated. You also talk about the gains, like Norway has transitioned in terms of electric vehicles dramatically, and Talk a little bit about that too, because it's similar to the case in Germany with their push to renewables.
It is. In the case of Norway, you're talking about EV penetration, or as far as all cars sold. I think last year it hit 70%. And if anyone likes to watch the Super Bowl, Will Ferrell had this hilarious ad in the Super Bowl about how Norway is out EVing the U.S. And it's true. EV sales in the U.S. have not broken 2%, and they're pushing 70% in Norway. But what's amazing to me, and really much more fascinating, is that even though you're now 7 in 10 cars that you're selling in Norway are electric, your total CO2 per unit of energy has not really gone down. It's gone down again by about 10%, which is largely in line with the U.S. experience and most other developed countries. So here's sort of another example. You taking the U.S. as a base case, where the U.S. Even today is still largely free market, and so you let sort of the hand of the market do its thing. You've been able to achieve the same reduction in CO2 per primary unit of energy as you had in Germany and as you had in Norway, even though Germany has gone this huge wind and solar push, and Norway has gone on this huge EV push. And there's reasons for it all, but part of the reason is that I think these technologies are not the panaceas that everyone hopes that they would be.
And, so it seems like even if we do there are a lot of reasons to believe, I guess, that even if we do push towards, renewables and electric vehicles in all these things, the rewards, the payoff is not going to be as great as we probably need it to be to meet some of these climate goals that people have set. But the other side of that too, that you point out, which is that a lot of these climate proposals also are based on a foundation of reducing overall energy consumption by 25%. And you suggest that that's just simply not possible. What leads you to believe that?
I guess history, and you're exactly right. When we started looking at some of these proposals and these plans, and 2020 was a really interesting year for a variety of reasons. But one of the things was that obviously because of COVID, total energy demand was down last year. It's the first time that that's happened in quite some time, and as a result of that, I think tanks could come out and say 2019 was the peak year of oil demand. People have been calling for peak oil demand sometime out in the future, but you couldn't obviously say that oil demand had peaked if it was still going up every day. So you had to say it's going to peak in 2 years or 3 years or 4 years. And that was, a dramatic statement, but, kind of people said, oh, that's kind of interesting. But now all of a sudden, because of COVID, you could say peak oil demand was actually last year. It's in the rearview mirror. I think that was a lot more dramatic. And so you saw a proliferation of reports from people like the IEA and BP and stuff like that all sort of called for, lower and lower and lower oil demand going forward. Now, what was interesting is that, we read those reports and we dug into them quite deeply. And like you said, a huge amount of that reduction is actually predicated in less energy demand across the board. So it's not just oil. They're assuming that oil demand goes down, but that every demand goes down. And if you look on a per capita basis, it goes down about 25% over the next 20 years. Now, that would be really shocking. To put it in perspective, I think that it goes from shocking to just wildly impossible. On the shocking side of things, I think we calculated it would take OECD or developed market energy demand back to like 1955 levels. So certainly we have some discretionary energy that we use in the developed world. We definitely could live our lives more energy efficiently. I don't think anyone wants to, but people love driving big cars and things like that. We could definitely make strides there. But to hit the numbers that the energy agencies are assuming, assumes we go back to 1955 levels. Now, I don't see that happening. That was something where, there's no air travel or very, very dramatically less air travel, things of that nature. Home heating and cooling were not the same as they are now. So I think the likelihood that happens is pretty low. But even more dramatic than that is the idea that the emerging markets are actually expected to decline in terms of energy per capita over the next 20 years. Now, that's just not going to happen. These countries are at a point in their economic development where they are all consuming dramatically more energy, not less. There's no efficiency gains you can make when you take people who live a rural agrarian lifestyle and you urbanize them. I don't care how fuel efficient you make their homes and cars, the net energy that they use goes up dramatically. And we've seen this over and over and over again in something that we like to call the S curve, which basically, as the name suggests, there's a sort of period of low energy demand at low levels of GDP, and then it ramps up dramatically at the sort of middle part, and then it begins to plateau. And you have a lot of people in that middle part right now, more than we've ever had before, by a wide margin. I think between 1970 and today, the average has been about 700 million people in that sort of meaty middle part of the S curve. You're now pushing 3.5 billion people, and so the idea that huge cohort, as they push through, is going to consume less absolute energy per person is not going to happen. So if that's where your analysis is based upon, then I guess you're setting yourself up for disaster.
So the realities of the energy transition are that the efficiencies of these new green energies are probably not anywhere near what we would hope them to be, and at the same time, we just can't expect the world to reduce its energy consumption anywhere near to the degree, like you said, back to 1950s levels for those of us at, developed worlds. That is, I agree with you. That's just not tenable. So it would seem that, no matter how aggressive we are at pushing towards renewables and EVs and these types of things, that traditional energy is going to be with us for a much longer time than a lot of these optimistic assumptions, would suggest. I guess what that leads me to is ironically, it would seem that the best way to play, this push towards, or I guess the transition to green energy is through commodities, because a lot of the commodities are used in this process, and then also in cleaner energy plays like natural gas, and you mentioned nuclear and uranium before.
Sure. Yeah, I think that's right. I guess it depends to what extent, to what extent you're looking for economic returns, I guess, versus altruistic goals. But I would point out that, and again, this is to me the more interesting part about these things is that even if what you're trying to do is stop global warming, we're going down the wrong path, and that's what's really scary to me. So yeah, I would think that looking at things, if you're open to looking at traditional hydrocarbons, then I think that that's certainly they're going to be with us for longer than people expect, and things are going to grow. And we've starved them for capital. If you absolutely, for whatever reason, refuse to have any traditional energy, then I guess it would be things that, for lack of a better word, can help make the problem better. And now, what is that? That's probably copper to help electrify more and more around the world, and it's uranium, which I'll talk about here in a second. But on the natural gas side, I think that's an important point, because that's really behind why the U.S. has been able to lower its CO2 per unit of energy without as big a renewables push. It's that we've transitioned from coal to natural gas, thanks to the cheap, abundant shale gas that we've enjoyed here in the United States, starting basically in the middle part of the 2000s. And natural gas is about the same energy efficiency, energy in, energy out, as coal, about 30 to 1, about half the CO2. And so, if you make that transition, it's not taking you down to, CO2 zero or whatever, although I would point out that neither are wind and solar. But it is, getting you a good reduction in CO2 without a huge impairment in the energy efficiency. If we want to then really start to think about how to really improve the situation, and I've told you all the ways that things can go south, going from an energy return on energy invested of 30 to 1 down to 4 to 1 clearly is going to be a challenge. But amazingly, nuclear energy, nuclear fission in particular, which is splitting of uranium isotopes, which is how we generate power today, has an energy return on energy invested of almost 100 to 1. So right off the bat, you're talking about a huge surplus of excess net power available for every unit of energy you put into the system. So, here you are, coal and gas, 30 to 1. You can either step and get much worse, but have, quote unquote, no carbon, or you can go and step and get much more energy efficient and have effectively zero carbon. And to me, it's just astounding that we've all sort of gone the wrong direction, if you will. Now, I think that's beginning to change. There's a little bit of a better perception today that perhaps uranium and nuclear power has a role to play. And so I hope that continues. The current administration has actually been a little bit more, or substantially more, pro-nuclear than I think some people had been concerned they might be. And so, maybe we are on the verge of a new sort of uranium renaissance. But I think that, when you look at the sort of ticking the boxes, you want something that's going to be more energy efficient, not less energy efficient, where that can recycle energy into more energy and into abundant surplus energy as efficiently as possible. And to the extent that you're concerned about the environment, you want them to be able to do that in a way that doesn't generate CO2. And there's not a lot of things that tick that box. There is one. I'm shocked that it's the technology that we've developed and discovered, 60 plus years ago, but we still seem unwilling as a society to embrace it. But I'm hoping that that's changing.
Well, that's another, I guess, irony of the ESG mandate is that, in starving a lot of these commodity-focused companies of capital, they're really making the cost of the transition to green energy more expensive in the long run, and so it's really kind of counterproductive to its own goals.
It is, it is. It's just astounding to me. Talking about before, Plug Power and Ballard and things like that. Not to sort of gang up on them, but Plug Power with limited revenues and a market cap of, at a couple weeks ago was pushing, I don't know, 30 or $40 billion. And Cameco, which is, and I should full disclosure, we do own Cameco, but Cameco, which is basically one of the only producing uranium companies in the world at this point, boasts after the recent run up from 5 to 15 in the last 12 months, has a whopping market cap of $6 billion. But one of those is going to be able to help address carbon going forward, and one will not.
It's fascinating. I've taken up a bunch of your time already, Adam. Before I let you go, I'm just curious, is there anything that you do outside of the markets, outside of the world of finance, that helps you just kind of push a mental reset button, or even maybe informs your investment process and makes you better at what you do?
Well, gosh, I wasn't prepared for that one. I think I've gone from being a fund analyst to a bit of a entrepreneur or whatever, having gone out on our own a couple of years ago. So unfortunately, for the last 5 years or so, there hasn't been much in the way of mental reset buttons. In fact, even I would have said read, but even my reading list in the last 12 months has been mostly energy books. So I think I probably am overdue for a reset. I'm like the router. Every you reset it, it works better.
Yeah, it's funny. I think you're the only other person besides Michael Oliver who does, momentum structural analysis. When I asked him that question, he said, no, this is my life. The markets are my life. And so I totally get it. I think when you find something you're passionate about and it I guess absorbs you in that type of a way, it's absolutely understandable. But Adam, thank you so much for taking the time. This has been wonderful.
Absolutely. Thank you so much. And I will give one last plug. I'll give a plug to my wife and two wonderful daughters at home, who those are probably the only things that have kept me grounded in the last 5 years.
Yeah. Well, and one other plug, I got to ask you, where can people kind of keep up with you and your ideas?
So, we've always been a huge believers in putting everything that we do out in the public domain, and so we write extensively, and everything that we do is out in the on our website. You can find it. Look up Goehring and Rozencwajg if you can figure out how to spell it. Otherwise, the website is Go Rozen. Figured that was nice and short. GOROZEN.com, and that has all of our writings going back several years. And please keep up with us that way.
Yeah, and what a wonderful resource. I highly recommend everybody go check out the website, and thank you for shortening it, because even spelling your last name has been a challenge for me. But Adam, thank you for taking the time. This has been great.
Thank you so much. I really appreciate it.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.